Hello again. Welcome to another episode of the Uranium Market Minute. Today is Friday, January 21st. This is episode number 67. My name is Justin Hune. I'm your host. I'm the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you so much for tuning in. Another very volatile, very exciting day in the uranium market. Before we get into it, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. Pretty bloody day out there, guys. I hope everybody is hanging in there. It's never pleasant to see this much red on the screen. And we're going to go into, just going to skip through really quickly the daily scoreboard, because honestly, who really cares about a minute change in the spot price or a minute amount of purchasing that spot did? Really what the trading action and what we're seeing on the screen really steals the show today. But I do have a really interesting interpretation of some data that I wanted to share with you guys. So let's just run through the daily scoreboard really quickly. We'll take a look at the charts, which is going to be a painful experience. And then I'm going to talk to you about something. I'm actually going to ask you a question in the mailbag. So running through really quick, spot price is down slightly, dropped under 45 a pound. $45 a pound today. I'm still seeing decent amount of trading action happen there. Spud was in the market yesterday, purchased 100,000 pounds of uranium. They did raise a small amount of money, only $100,000. They were barely above a premium to NAV for a moment there. They took advantage of it for a minute. That's 2.6 million pounds they've purchased year to date, raised 119.2 million. They closed at a premium to NAV yesterday, actually 0.48%, not quite enough to raise capital. Today, the physical uranium trust is getting crushed in the trading action. So more than likely they're at multiple percentage points at a discount to NAV. So not any cash raised today. We'll see if they were in the market purchasing. Highly unlikely they purchased much, if any at all, because they're now down to 23 million in cash. They really need to see new inflows of capital here in a substantial way in order to come back into the market and do any amount of significant purchasing. Again, that's 40. They now hold 44 million total pounds of uranium, and that's just unbelievable. They've raised over 1.1 billion. So SPUT still very much on the scene. However, obviously when they're trading at a discount to NAV like today, their hands are kind of tied and their cash reserves have been drawn down. So we need to see new flows into this. Turning to the sector equity ETFs, URA reported an increase of 1.1 million shares. And this is going to be the subject of the mailbag, because this is a significant point to note, in my opinion. Before we do that, before I ask you guys a question, let's look at the charts really quick. URA getting just destroyed today. The market just closed as I'm recording this 3 minutes ago. Big volume, big selling volume, closed near its lows on the day. A tiny amount of dip buying, but nothing really of note. Positive divergence completely gone at this point. MACD turning down. This chart is now basically broken. The 50-day moving down pretty steeply, the 200-day flattening. We're not quite at that quote unquote death cross or bearish cross of the 50-day falling below the 200-day. I hope that we do not see that. I don't think that we will. Will we see a V-shaped recovery? I'm not really sure. Unlikely. I do think we'll see some support sometime soon, possibly next week. Don't necessarily think this is the bottom, but I do think that this is getting overblown in terms of correlation, as the uranium market now being considerably negatively correlated to any weakness in the broad market. The broad indices were down today. However, they did bounce back significantly throughout the day, but the uranium sector did not. So this negative divergence between uranium and the broad markets is definitely not something that's very comforting, let's say. But I do have some interesting news, like I mentioned. So we'll get to that in just a moment. The Sprott Physical Uranium Trust also just getting smacked today, going down pretty steeply, another 5 or 10% down to that 200-day moving average that's still rising. The 50-day relatively flat. Overall, this chart is holding up better than most, considering that the spot price is holding up better than the equities significantly. So the underperformance of the equities relative to the spot price is highlighted in this particular chart. Let's take a look at Cameco. Cameco falling down, closing well below the rising 200-day moving average. Again, a pretty broken chart, although we did have a low of this same level right about $20, just above $20 back in December. We'll see if that holds. Either way, we've got a Fed meeting next week and we're going into the weekend, which is why we probably did not see much dip buying happen today overall. All right, so mailbag question today. So let's talk about this situation with the outstanding shares increasing now at all-time highs for both URA and URNM. So over the period of the highs of November to now, we've now seen the equities in the space fall around 40 to 45% if we're including today's big down day. However, we've seen the outstanding shares of these ETFs increase. Now, my initial interpretation of that I've mentioned on a few market minutes, including yesterday, is kind of obvious. And that's that the selling is not coming from the ETFs. The selling is coming from the liquidating of the individual holdings. That, in my opinion, has had large participation by retail traders, okay? So retail, on balance, retail during periods of selling are sellers, okay? So on a day like today, you might have maybe 20%, 15 to 20% of retail were acting in a contrarian manner and buying what they felt were quality equities on sale, right? Then you'll have 40% that's frozen, curled up in the fetal position, not wanting to look at their phones. And then you have 40% that were sellers. On balance, that's net selling, okay? And so really, when you have bloody markets, typically what you have is what's called smart money and dumb money. And that's in any market, right? And so what that really means, smart money is referring to institutional investors. These are investors who are professionals. These are people that have been doing it typically for a very long time. They do it in a professional manner. They're managing other people's money. So a lot of times they are more conservative, but they can also be more aggressive, especially in moments like this. So what we are concluding by seeing the outstanding shares, actually, before I'm going to get into that, let me ask you the question. Do you think that the outstanding share count increases in the ETFs? Who do you think is doing this buying? You think it's the smart money or the dumb money? Well, I think you probably know what I think. I think it's clearly the smart money. So what does that mean? That means while retail and perhaps some institutions, but a lot of retail selling down the sector, some taking some tax loss in December. The sector was relatively weak in December as retail traders realized that there wasn't really going to be a continuation of a seasonality move that we were expecting in December and into January. Then retail was thinking, okay, December sucked. Now we're in a new year. Now we're going to see this turnaround. A lot of us were feeling that we would see some support. We started to see that support. A lot of money came in during the Kazakhstan news, expectations that would disrupt the market. That didn't disrupt the market. A lot of retail bailed. And so what we've seen is an overall selling across the sector, yet money is flowing into the ETFs. This is institutional money positioning. They are buying the shares you are selling, essentially. They're buying into the ETFs that offer them liquidity at fire sale prices. That's what's happening here. And so as we see these very difficult to stomach corrections in this market that are not uncommon, again, in resource markets, these are unbelievably volatile, as I've said over and over. And these types of corrections happen, okay? They just happen. And so while you're looking at the screen and it looks terrible, I like to remember that this is a fundamental investment. This is not a technical trade. If this were a technical trade, I would have been out a long time ago. Okay, I would have been out when the sector lost the 50-day moving average, late November, early December. Okay, but it's not. This is a fundamental investment for us. So we essentially, we had some trades roll off, so we're sitting on some cash. We are planning to deploy that. If you are a member, you will be receiving a bulletin shortly, within probably the next week, as we believe that we will find a cyclical bottom here shortly. We are going to be putting some of that cash to work, and likely that will be something, possibly a more aggressive play, like an options trade. That will be coming out shortly. But this is a long-term investment for us. So our core positions we essentially hold when we have cash, when we create some cash, we will put that to work during times like this, okay? So this is what we think we're seeing. The professionals are buying and the hot money is leaving, okay? The retail tourists are leaving and the professionals are showing up for a seat at the table. That, in my opinion, is unbelievably bullish. And at the very least, it is something to keep in the back of your mind during, if you're just holding and it's difficult to see, then you can at least know that there's smart money positioning, okay? That's helpful. And these data, and this is not just a bullish interpretation. This is data. This is data. Money is coming into the ETFs while retail is selling down the holdings. That's what's happening. I mean, retail and possibly some institutions as well, but smart money they're adding outstanding shares into the ETF. Smart money is positioning here. Okay, so I'm going to leave you all with another quote, a contrarian quote, because a lot of what happens in these sectors is retail arrives to the sector in hordes during periods of euphoria. Okay, so when we have the markets moving up on big volume back in August, September, again in October, early November, that's when a lot of new entrants came to the uranium space. And what happens essentially is that a lot of those retail investors come in, or traders, they come in and they get really bullish on the sector. Like, I can't believe I'm just finding out about this. No, I wish I had bought back then. I wish I had bought in March of 2020. And I can't, these guys that positioned since 2017, 2018, they're sitting pretty, but now I'm here and the sector's gotten away from me. I wish that I had another opportunity to add at lower prices, and then the market gives it to you and there's nobody there to buy it. This is just the way it goes. It will never change. It will never change. It will always be like this. The majority of retail is buying at the highs and selling at the lows. And the way to make money in a long-term fundamental investment is to do the opposite. So on that note, I love this book, The Most Important Thing, Howard Marks. This is a quote I've probably read before, but I'm going to do it again because I read this chapter often. It's a good reminder. Large amounts of money aren't made by buying what everybody likes. They're made by buying what everybody underestimates. So you have to ask yourself, what is retail underestimating here? And is that an opportunity? And are there signs that I'm not alone in this investment? There you go, folks. I hope you have a great weekend, and I hope you hung in there. It was a nasty day. It was a nasty week. I think that we're not too far from the lows. I would like to think that next week might mark at least a intra-cycle low with the Fed meeting, and with hopefully the broad markets can kind of stabilize as well. And we'll recognize the opportunity here, as a lot of these stocks have gotten very cheap relative to the fundamental developments that have happened since the last time they were at this level. All right, guys, have a great weekend. And as always, be well. We'll see you next week. Cheers.